Overview of AI in financial markets. Artificial intelligence, AI, has fundamentally reshaped financial markets, marking a significant departure from traditional rule-based trading systems to sophisticated machine learning, ML, models, capable of discerning intricate patterns within vast and complex datasets. This evolution has enhanced predictive analytics and optimized trading strategies. The progression of AI in finance can be broadly categorized into distinct phases. 1. Rule-based systems, 1980s-1990s. The earliest applications of AI in finance were characterized by predefined rules and expert systems. 1. These systems, while pioneering, were limited by their lack of adaptability and reliance on rigid conditions, making them less effective in dynamic market environments. 2. Machine learning models, 2000s-2010s. As computational power increased and big data analytics became more accessible, AI systems began to incorporate supervised and unsupervised learning techniques. These models predicted stock movements based on historical patterns, marking a significant leap in predictive accuracy and adaptability. 3. Deep learning and reinforcement learning, 2010s present. Contemporary AI applications utilize neural networks, deep learning architectures, and reinforcement learning to analyze real-time data, forecast trends, and dynamically optimize trading strategies. These advanced techniques enable AI to adapt to rapidly changing market conditions and make more nuanced predictions. AI's presence in financial markets is diverse, encompassing a range of techniques each suited to specific tasks. 1. Supervised learning. Primarily used for stock price prediction by training models on labeled historical data. Algorithms such as regression models and support vector machines, SVMs, are employed to forecast future price movements based on past trends. 2. Unsupervised learning focuses on detecting anomalies and clustering stocks based on similarity without explicit labels. Techniques like k-means clustering are used for sector-based analysis and identifying unusual trading patterns that may indicate emerging opportunities or risks. 3. Deep learning employs neural networks with multiple layers to analyze complex patterns in financial data. Recurrent neural networks, RNNs, including long short-term memory, LSTM, networks, are used for sequence prediction and sentiment analysis, capturing temporal dependencies in financial time series data. 4. Reinforcement learning involves training agents to make decisions in a dynamic environment to maximize a reward. In stock trading, reinforcement learning algorithms can optimize trading strategies by learning from historical data and adapting to changing market conditions, often outperforming traditional methods in volatile markets. 5. Natural language processing, NLP. NLP techniques are used to analyze news articles, social media feeds, and other textual data to gauge market sentiment. By quantifying emotions and opinions, NLP helps traders make informed decisions based on the prevailing market mood. For example, if NLP algorithms detect a significant increase in negative sentiment towards a particular stock, traders may choose to reduce their positions or even short the stock. 1.2. Importance of AI in modern trading. AI has become integral to modern trading, providing several key advantages over traditional, human-driven methods. These benefits underscore AI's transformative role in financial markets. 1. Elimination of emotional bias. AI algorithms make decisions based on data and predefined rules, removing the influence of human emotions such as fear and greed, which can lead to irrational trading behaviors. 2. Speed and efficiency. AI facilitates high-frequency trading, HFT, enabling the execution of thousands of trades in milliseconds. This capability allows firms to capitalize on fleeting price discrepancies and arbitrage opportunities that would be impossible for human traders to exploit. 3. Enhanced risk management. AI-based systems continuously monitor portfolio risk in real time, dynamically adjusting asset allocations to hedge against potential losses. These systems can quickly identify and respond to emerging risks, helping to protect investments and minimize losses. 4. Adaptive learning. AI algorithms continuously learn from new data, refining predictions, and adjusting strategies to improve performance. This adaptive capability allows AI systems to stay ahead of market changes and maintain a competitive edge. Several prominent hedge funds and proprietary trading firms have successfully integrated AI into their operations. 1. Renaissance Technologies. Renowned for its Medallion Fund, which has consistently outperformed traditional market indices through AI-driven trading models. The firm's success is attributed to its sophisticated algorithms and data analysis techniques. 2. Two Sigma, a quantitative investment firm that employs AI and big data analytics for predictive modeling and automated trading. Two Sigma's data-driven approach has enabled it to generate consistent returns and attract significant investment. 3. Citadel Securities, a leading market maker that leverages deep learning models to optimize trade execution and liquidity provision. Citadel Securities' AI-powered HFT systems help to ensure efficient and liquid markets. While AI offers significant advantages, it is important to acknowledge its limitations within the complex dynamics of the stock market. Data quality issues, such as inaccuracies and biases in historical data, can lead to flawed models. Overfitting, where a model performs well on training data, but poorly on new data, is another significant challenge. Additionally, the inherent unpredictability of markets and the occurrence of black swan events, rare and unforeseen events with a significant impact, such as the 2008 financial crisis or the COVID-19 pandemic, can render even the most sophisticated AI models ineffective. Addressing these limitations is crucial for the responsible and effective deployment of AI in stock market prediction. Given these considerations, it is essential to understand the purpose and scope of this discussion, which will delve into the multifaceted role of AI in stock market predictions. 1.3. Purpose and scope of the article. This article aims to provide a thorough examination of AI's role in stock market predictions, offering insights for both institutional and retail investors. The scope of this article includes 1. Historical evolution. Tracing the development of AI in financial markets from early rule-based systems to advanced neural networks, highlighting key milestones and innovations. 2. Core technologies. Analyzing the underlying technologies that power AI-driven trading, including machine learning, deep learning, reinforcement learning, and natural language processing. 3. Real-world applications. Exploring practical applications of AI in stock trading, such as predictive analytics, automated trading, and sentiment analysis, with examples of successful implementations. 4. Advantages and limitations. Evaluating the benefits and drawbacks of using AI in trading, discussing its impact on market efficiency, accuracy, and potential risks. 5. Case studies and future trends. Presenting case studies of AI-driven trading platforms and hedge funds, and exploring emerging AI technologies and their potential implications for the future of finance. 2. The evolution of AI in stock market analysis. 2.1. Early adoption of AI in trading. The integration of artificial intelligence, AI, into stock market analysis began modestly, but laid the groundwork for the sophisticated systems that dominate trading floors today. Early adopters, such as Renaissance Technologies, were pioneers in quantitative investing, leveraging statistical models and machine learning techniques long before they became mainstream. Founded by James Simons, Renaissance Technologies distinguished itself through its data-driven approach and the recruitment of experts from non-financial fields like mathematics, physics, and signal processing. A prime example of their early success is the Medallion Fund. This fund, accessible exclusively to the firm's employees, has achieved unparalleled returns by identifying and exploiting non-random patterns in market behavior. The fund's consistent outperformance, often attributed to its sophisticated, AI-driven models, set a new benchmark in the industry and inspired a wave of quantitative approaches to investment management. Besides Renaissance Technologies, other early adopters included firms like D.E. Shaw and AQR Capital Management, which also recognized the potential of quantitative methods in finance. These firms began experimenting with statistical models and rule-based systems to identify trading opportunities and manage risk more effectively. These early AI systems were not without their challenges. They faced limitations in terms of computational power, data availability, and model complexity. Data cleaning and preprocessing were particularly challenging, as financial datasets were often incomplete, inconsistent, and prone to errors. Overfitting was also a significant concern, as early models were prone to memorizing historical data, rather than generalizing to new market conditions. Moreover, the regulatory landscape was still evolving, and there was limited guidance on the use of AI in financial markets. Despite these challenges, these early adopters laid the foundation for the AI-driven trading systems that are prevalent today. 2.2. Transition from traditional algorithms to machine learning. The transition from traditional algorithms to machine learning marked a pivotal shift in stock market analysis. Traditional algorithms, often based on predefined rules and statistical methods, were limited in their ability to adapt to changing market dynamics. These traditional approaches typically relied on linear models and statistical assumptions that often failed to capture the complex, non-linear relationships present in financial data. For example, traditional time series analysis techniques like ARIMA models assume stationarity, which is often violated in real-world financial time series. However, advancements in computational power and the increasing availability of big data created an environment ripe for the application of machine learning techniques. Cloud computing played a crucial role in this transition by providing scalable and cost-effective access to the computational resources needed to train and deploy complex machine learning models. Similarly, the development of GPU, graphics processing unit, acceleration significantly reduced the training time for neural networks, making deep learning more feasible for financial applications. Machine learning algorithms, unlike their traditional counterparts, can learn from data, identify patterns, and make predictions without explicit programming. This adaptability allowed them to capture nonlinear relationships and complex dependencies in financial data that were previously undetectable. The shift was further accelerated by 1. Increased data availability. The proliferation of financial data, including historical prices, news feeds, and macroeconomic indicators, provided the raw material needed to train sophisticated machine learning models. 2. Algorithmic advancements. Innovations in machine learning algorithms, such as support vector machines, SVMs, random forests, and neural networks, offered new tools for prediction and analysis. 3. Growing acceptance. As early successes demonstrated the potential of machine learning, more firms began to embrace these techniques, driving further investment and innovation in the field. The transition from traditional algorithms to machine learning was not without its challenges. One major concern was the black box nature of many machine learning models, which made it difficult to interpret their predictions and understand their underlying reasoning. This lack of transparency raised concerns about model explainability and accountability, particularly in regulated industries like finance. 2.3. Key milestones in AI-driven market predictions. Several key milestones underscore the growing impact of AI in accurately predicting market movements, validating its superiority over traditional methods. While specific examples of AI models consistently predicting major market movements are closely guarded secrets within proprietary trading firms, academic research and industry reports offer compelling evidence of AI's predictive power. For instance, a study published in the Journal of Financial Data Science found that AI models incorporating sentiment analysis of news articles and social media data outperformed traditional econometric models in forecasting stock price movements. The study demonstrated that AI algorithms could identify subtle shifts in market sentiment that often precede significant price changes. Moreover, AI has demonstrated its ability to predict flash crashes and other extreme market events by identifying anomalous trading patterns and detecting unusual correlations between assets. For example, researchers at the MIT Laboratory for Financial Engineering developed an AI system that could detect early warning signs of the 2010 flash crash by analyzing high-frequency trading data. However, the use of AI in predicting market movements is not without its challenges and controversies. Critics argue that AI models are prone to overfitting and may not generalize well to new market conditions. There are also concerns about the potential for AI-driven trading systems to exacerbate market volatility and contribute to systemic risk. It's important to note that specific, publicly available examples of AI models accurately predicting major market movements are rare due to the proprietary nature of these algorithms. However, the growing body of evidence suggests that AI has become an indispensable tool for investors seeking to gain a competitive edge in today's rapidly evolving financial markets. To visually represent this evolution, a timeline showcasing key events, such as the founding of Renaissance Technologies, the rise of cloud computing, and the publication of influential research papers, would greatly enhance the section's impact. Note, I am unable to create actual visuals, but this is where a timeline could be inserted. 2.4. Conclusion. In summary, the evolution of AI in stock market analysis has been marked by significant milestones and paradigm shifts. From the early adoption of quantitative methods by pioneering firms to the rise of machine learning and the increasing availability of data and computational power, AI has transformed the way financial markets are analyzed and predicted. Despite the challenges and controversies, AI has emerged as a powerful tool for investors seeking to gain a competitive edge in today's rapidly evolving financial landscape. Looking ahead, further advancements in AI technology and increasing integration with other fields, such as quantum computing and blockchain, promise to unlock new opportunities and further revolutionize the world of finance. 3. Core technologies powering AI and stock trading. Artificial intelligence, AI, In stock trading is not a monolithic entity, but rather a convergence of several core technologies, each contributing uniquely to the predictive power and operational efficiency of AI-driven systems. This section delves into the main pillars supporting AI's capabilities in financial markets, focusing on machine learning, ML, models, natural language processing, NLP, for sentiment analysis, neural networks, and deep learning, and reinforcement learning in algorithmic trading. 3.1 Machine learning, ML, models. Machine learning models form the backbone of AI-driven stock trading systems, enabling computers to learn from data without explicit programming. Different ML models offer distinct advantages in forecasting accuracy, depending on the specific task and characteristics of the data. Here's a comparative overview, expanding on the models discussed previously. 1. Decision trees. These models are intuitive and easy to interpret, making them useful for identifying key factors influencing stock prices. Decision trees partition data into subsets, based on a series of decision rules, ultimately leading to a prediction. However, they can be prone to overfitting, especially with complex datasets. 2. Random forests. As an ensemble learning method, random forests mitigate the overfitting problem of decision trees by creating multiple trees and aggregating their predictions. This approach enhances robustness and predictive accuracy, making random forests a popular choice for stock prediction. They are particularly effective in handling nonlinear relationships and interactions between variables. 3. Support vector machines, SVMs. SVMs are powerful models for classification and regression tasks. They aim to find the optimal hyperplane that separates different classes of data points, maximizing the margin between them. SVMs are effective in high-dimensional spaces and can handle nonlinear relationships using kernel functions. However, they can be computationally intensive, especially with large datasets. 4. Neural networks. These models, inspired by the structure of the human brain, consist of interconnected nodes, neurons, that process and transmit information. Neural networks can learn complex patterns and dependencies in data, making them suitable for a wide range of tasks, including stock prediction. However, they require large amounts of data and careful tuning to avoid overfitting. 5. K-nearest neighbors, KNN. KNN is a simple yet effective algorithm that classifies data points based on the majority class among their nearest neighbors. It's easy to implement and can be effective for short-term price prediction. However, KNN can be sensitive to the choice of distance metric and the value of K, number of neighbors, and it can be computationally expensive for large datasets. 6. Naive Bayes. Naive Bayes is a probabilistic classifier based on Bayes' theorem, with a naive assumption of independence between features. Despite its simplicity, naive Bayes can be surprisingly effective for sentiment analysis and text classification in financial news. However, its assumption of feature independence is often violated in real-world financial data. 7. Gradient boosting machines, GBMs. GBMs are ensemble learning methods that combine multiple weak learners, typically decision trees, to create a strong learner. GBMs are highly versatile and can be used for both regression and classification tasks. They are particularly effective in capturing complex nonlinear relationships in financial data. However, GBMs require careful tuning to avoid overfitting and can be computationally intensive. Each of these models brings unique strengths and weaknesses to the table, offering a diverse toolkit for building sophisticated AI-driven stock trading systems. The choice of which model to use often depends on the specific characteristics of the data and the trading strategy being employed. 3.2. Natural Language Processing, NLP, for sentiment analysis. Moving beyond numerical data, natural language processing, NLP, plays a crucial role in enhancing predictive accuracy by extracting and analyzing sentiment from textual data, such as news articles, social media posts, and financial reports. By quantifying emotions and opinions expressed in these sources, NLP provides valuable insights into market sentiment, which can significantly impact stock prices. NLP integrates with other AI tools to improve predictive accuracy. For example, sentiment scores derived from NLP can be used as features in machine learning models, providing additional information beyond traditional financial data. AI-driven sentiment analysis has been shown to impact major stock movements. For example, a sudden increase in negative sentiment towards a company on social media may precede a decline in its stock price. Specific techniques used in NLP for sentiment analysis include 1. Sentiment lexicons. These are pre-built dictionaries that assign sentiment scores to words and phrases. Algorithms can then use these lexicons to calculate the overall sentiment of a text. 2. Machine learning-based sentiment analysis. These approaches train machine learning models on labeled data to classify text as positive, negative, or neutral. These models can capture more nuanced sentiment than lexicon-based methods. 3. Deep learning-based sentiment analysis. Deep learning models, such as recurrent neural networks, RNNs, and transformers, can capture long-range dependencies in text, improving the accuracy of sentiment analysis. In practice, NLP is used to analyze a wide range of financial texts. 1. Earnings call transcripts. NLP can be used to analyze the tone and content of earnings call transcripts, identifying key themes and assessing management sentiment. For example, if a CEO uses vague or evasive language, it may signal concerns about the company's future prospects. 2. Analyst reports. NLP can be used to extract recommendations, price targets, and other key information from analyst reports. This can help traders make more informed decisions about which stocks to buy or sell. 3. Financial news articles. NLP can be used to track news coverage of companies and industries, identifying potential market-moving events. For example, if a company is the subject of a negative news story, it may lead to a decline in its stock price. However, NLP-based sentiment analysis is not without its limitations. One major challenge is the ambiguity and subjectivity of language. Sentiment can be highly context-dependent, and algorithms may struggle to accurately interpret sarcasm, irony, or humor. Another challenge is the presence of noise and misinformation in financial texts. Social media, in particular, can be a breeding ground for rumors and fake news, which can distort sentiment analysis results. 3.3. Neural networks and deep learning. Neural networks, particularly deep learning models, have revolutionized stock market forecasting due to their ability to analyze sequential financial data and capture intricate patterns that are often missed by traditional methods. Case studies of successful applications: LSTM networks for time series prediction, long short-term memory, LSTM, networks, a type of recurrent neural network, RNN, are particularly well suited for analyzing sequential data like stock prices. LSTMs can capture long-range dependencies in time series data, allowing them to make more accurate predictions. Several studies have demonstrated the effectiveness of LSTMs in predicting stock price movements. Convolutional neural networks, CNNs, for pattern recognition, CNNs, originally developed for image recognition, can also be used to identify patterns in financial data. For example, CNNs can be trained to recognize chart patterns or candlestick patterns, which are often used by technical analysts to make trading decisions. In addition to LSTMs and CNNs, other deep learning architectures commonly used in stock trading include recurrent neural networks, RNNs. RNNs are designed to process sequential data, making them well suited for time series analysis. However, traditional RNNs suffer from the vanishing gradient problem, which limits their ability to capture long-range dependencies. Generative adversarial networks, GANs. GANs consist of two neural networks, a generator and a discriminator, that compete against each other. GANs can be used to generate synthetic financial data, which can be used to augment training datasets and improve the performance of other AI models. Autoencoders. Autoencoders are neural networks that learn to compress and reconstruct input data. They can be used for dimensionality reduction, feature extraction, and anomaly detection in financial data. Each of these architectures offers unique advantages and disadvantages for stock market forecasting. RNNs are simple and easy to implement, but struggle with long-range dependencies. LSTMs address this limitation but are more complex. CNNs are effective for pattern recognition, but may not be well suited for time series analysis. GANs can generate synthetic data but are difficult to train. Autoencoders are useful for dimensionality reduction, but may not capture all relevant information. 3.4. Reinforcement learning and algorithmic trading. Reinforcement learning, RL, is a type of machine learning where an agent learns to make decisions in an environment to maximize a reward. In algorithmic trading, reinforcement learning can be used to optimize trading strategies in real time. How reinforcement learning optimizes trading strategies. Defining the environment. The trading environment includes the market conditions, such as stock prices, trading volume, and order book data. Defining the agent. The trading agent is the AI algorithm that makes trading decisions. Defining the actions. The actions the agent can take include buying, selling, or holding a stock. Defining the reward. The reward is the profit or loss generated by the agent's trading decisions. The agent learns to make optimal trading decisions by trial and error, receiving feedback in the form of rewards. Over time, the agent learns to maximize its cumulative reward, resulting in an optimized trading strategy. In practice, reinforcement learning is used to optimize order execution. RL can be used to optimize the timing and size of orders to minimize transaction costs and maximize execution prices. For example, an RL agent can learn to split large orders into smaller orders and execute them over time to avoid impacting market prices. Manage portfolio risk. RL can be used to dynamically adjust portfolio allocations to manage risk and maximize returns. For example, an RL agent can learn to reduce exposure to risky assets during periods of high volatility. Develop market-making strategies. RL can be used to develop market-making strategies that provide liquidity to the market while earning a profit. For example, an RL agent can learn to set bid and ask prices that attract order flow and generate revenue. Despite its potential, Reinforcement learning in algorithmic trading faces several challenges. One major challenge is the non-stationarity of financial markets. Market conditions are constantly changing, which means that an RL agent that is trained on historical data may not perform well in the future. Another challenge is the exploration-exploitation dilemma. RL agents must balance the need to explore new trading strategies with the need to exploit existing strategies that are known to be profitable. To provide a more engaging experience, a diagram illustrating the interaction between these different technologies could be added. 3.5. Conclusion. In conclusion, Section 3 provides a comprehensive overview of the core technologies that power AI in stock trading, highlighting the unique capabilities of a wide range of machine learning models, natural language processing for sentiment analysis, neural networks and deep learning, and reinforcement learning in algorithmic trading. These technologies, working in concert, enable AI-driven systems to analyze vast amounts of data, identify complex patterns, and make informed trading decisions, ultimately transforming the landscape of financial markets. The ongoing advancements in these fields promise to further enhance the capabilities of AI in stock trading, leading to more sophisticated and effective trading strategies in the years to come. 4. AI applications in stock market predictions. Artificial intelligence, AI, has permeated nearly every facet of stock market prediction, enabling a range of sophisticated applications that were once considered the realm of science fiction. This section will explore key areas where AI is making a significant impact: predictive analytics for stock price movements, AI-based technical analysis tools, automated and high-frequency trading, sentiment analysis, and portfolio optimization. 4.1. Predictive analytics for stock price movements. AI's prowess in predictive analytics offers both short-term and long-term forecasting capabilities, catering to diverse investment strategies. However, the effectiveness of AI in predicting stock price movements varies, depending on the time horizon and market conditions. Short-term forecasting. AI models excel at identifying short-term price patterns and making predictions based on technical indicators, order book data, and news sentiment. These models are often used in high-frequency trading, HFT, to capitalize on fleeting price discrepancies and arbitrage opportunities. For example, AI algorithms can analyze Level 2 market data to predict short-term price movements with a high degree of accuracy, enabling HFT firms to profit from small price differences across exchanges. However, the reliance on high-frequency data and complex algorithms makes these models susceptible to overfitting and requires constant recalibration to maintain their predictive power. Additionally, unforeseen events and sudden shifts in market sentiment can quickly render short-term forecasts inaccurate. Long-term forecasting. Long-term forecasting is inherently more challenging due to the complex interplay of macroeconomic factors, industry trends, and unforeseen events. While AI models can incorporate these factors into their predictions, the accuracy of long-term forecasts is generally lower than that of short-term forecasts. AI models can leverage economic indicators, such as GDP growth, inflation rates, and unemployment figures, to predict long-term stock market trends. However, these models struggle to accurately account for unpredictable events, like geopolitical crises, technological disruptions, and changes in consumer behavior. The black swan events, as discussed previously, exemplify this challenge. Consequently, long-term AI forecasts should be viewed as probabilistic scenarios rather than definitive predictions. Two primary trading strategies leverage AI-driven predictive analytics. Mean reversion strategies. These strategies assume that stock prices tend to revert to their historical average over time. AI models can identify overbought or oversold conditions and predict when a stock price is likely to revert to its mean. For example, if a stock price has deviated significantly from its moving average, an AI model may predict that it is likely to decline in the short term. Sophisticated mean reversion strategies use Kalman filters and regime detection algorithms to identify periods of mean reversion with greater accuracy. A specific example is pairs trading, where AI identifies two correlated stocks and trades on the expectation that their price differential will revert to its historical mean. Momentum-based predictions. These strategies assume that stocks that have performed well in the past are likely to continue performing well in the future. AI models can identify stocks with strong momentum and predict that they will continue to rise in price. For example, if a stock price has been consistently increasing over the past few months, an AI model may predict that it will continue to rise in the near future. AI models can also incorporate volume and volatility data to identify stocks with strong momentum and a low risk of reversal. Trend following is a classic example, where AI algorithms identify stocks exhibiting strong upward trends and initiate long positions, riding the momentum until the trend shows signs of reversal. The choice between mean reversion and momentum-based strategies depends on the investor's risk tolerance and investment horizon. Mean reversion strategies tend to be more conservative and are suitable for investors who prefer lower risk. Momentum-based strategies tend to be more aggressive and are suitable for investors who are willing to take on more risk. Understanding the nuances and limitations of each strategy, along with how AI augments them, is crucial for successful deployment, paving the way for exploring AI's enhancements to traditional technical analysis. 4.2. AI-based technical analysis tools. AI is enhancing traditional technical analysis by automating pattern recognition and generating more accurate trading signals. Traditional technical indicators, such as relative strength index, RSI, moving average convergence divergence, MACD, and Bollinger Bands, are enhanced through AI. AI-driven RSI. AI can improve the RSI by incorporating additional data sources, such as sentiment analysis and macroeconomic indicators. For example, an AI-driven RSI may consider the sentiment of news articles and social media posts related to a stock, as well as economic data such as interest rates and inflation. This provides a more holistic view of market conditions and can lead to more accurate trading signals. AI algorithms can also be used to identify optimal thresholds for overbought and oversold conditions, leading to more timely and accurate trading signals. AI-driven MACD. AI can optimize the parameters of the MACD to better capture market dynamics. For example, an AI-driven MACD may use a shorter moving average for fast-moving stocks and a longer moving average for slow-moving stocks. This adaptive approach allows the MACD to be more responsive to changing market conditions. Moreover, AI can identify nonlinear relationships between MACD signals and future price movements, leading to more sophisticated trading strategies. AI-driven Bollinger Bands. AI can dynamically adjust the width of the Bollinger Bands based on market volatility. For example, an AI-driven Bollinger Band may widen during periods of high volatility and narrow during periods of low volatility. This helps traders avoid false signals and make more informed decisions. AI can also incorporate machine learning techniques to predict future volatility, allowing for more proactive adjustments to the Bollinger Bandwidth. In essence, AI takes traditional technical analysis to the next level by dynamically adjusting parameters and incorporating additional data sources to generate more accurate trading signals. These AI-driven tools help traders make more informed decisions and improve their overall trading performance. One way AI is used is to develop entirely new technical indicators by analyzing vast amounts of historical data and identifying patterns that are not readily apparent to human analysts. However, relying solely on AI-driven technical analysis can be risky, as these indicators are based on historical data and may not always accurately predict future price movements. A balanced approach, combining AI-driven insights with fundamental analysis and risk management, is essential. While AI enhances these tools, it's important to acknowledge that technical analysis, even with AI, is not foolproof and should be used in conjunction with other forms of analysis. Transitioning from theoretical analysis, AI also makes waves in more active trading methodologies, such as automated and high-frequency trading. 4.3. Automated trading and high-frequency trading, HFT. The ultra-fast execution speeds facilitated by AI give it a competitive edge in automated trading and high-frequency trading, HFT. AI's ability to process vast amounts of data in real time, combined with its ability to make split-second decisions, makes it ideally suited for HFT. Latency reduction. In HFT, every millisecond counts. AI-driven HFT systems employ various techniques to reduce latency, including colocation services. HFT firms often co-locate their servers with exchange servers to minimize the distance data must travel. Optimized algorithms. AI algorithms are designed to execute trades as quickly as possible, minimizing the time it takes to process data and send orders to the exchange. Direct market access, DMA. DMA allows HFT firms to bypass intermediaries and connect directly to the exchange, reducing latency and improving execution speeds. Advantages of AI in HFT. Speed. AI can execute trades in milliseconds, allowing firms to capitalize on fleeting price discrepancies and arbitrage opportunities. Efficiency. AI can process vast amounts of data in real time, identifying trading opportunities that would be impossible for human traders to spot. Precision. AI can execute trades with greater precision than human traders, minimizing slippage and maximizing profits. However, HFT is not without its risks. AI-driven HFT systems can contribute to market volatility and increase the risk of flash crashes. For example, the 2010 flash crash was partially attributed to HFT algorithms that amplified market volatility. Beyond the risk of flash crashes, HFT raises ethical concerns about fairness and market manipulation. Some critics argue that HFT algorithms can exploit order flow and front-run other investors, creating an uneven playing field. There are ongoing debates about the role of regulators in overseeing HFT and ensuring market integrity. Furthermore, regulatory scrutiny of HFT practices is increasing, highlighting the need for responsible deployment of AI in this domain. 4.4. Sentiment analysis of financial news and social media. AI-driven sentiment analysis has become a critical tool for understanding how news and social media chatter influence stock prices. By analyzing the emotional tone of news articles, social media posts, and other textual data, AI can identify shifts in market sentiment that often precede significant price changes. Case studies of sentiment shifts impacting stock prices. Company A. A major technology company experienced a significant decline in its stock price after a negative news article was published about its data privacy practices. AI-driven sentiment analysis accurately predicted the decline, based on the negative sentiment expressed in the article. Algorithms analyzed the tone of the article, focusing on words and phrases associated with negative sentiment, and correctly predicted the stock's downward trajectory. Company B. A pharmaceutical company saw its stock price surge after announcing positive results from a clinical trial. AI-driven sentiment analysis identified the positive sentiment in news articles and social media posts related to the announcement, predicting the subsequent price increase. The algorithms detected an increase in positive keywords associated with the company and its prospects, leading to the accurate prediction. AI identifies market-moving news events in real time by monitoring news feeds. AI algorithms continuously monitor news feeds from various sources, identifying articles and headlines that are relevant to the stock market. These algorithms filter news based on keywords, company names, and ticker symbols. Analyzing social media, AI algorithms track social media posts, tweets, and other online content, identifying trending topics and gauging public sentiment towards companies and industries. Social media analysis includes tracking hashtags, mentions, and overall sentiment scores. Extracting key information. AI algorithms extract key information from news articles and social media posts, such as company names, ticker symbols, and sentiment scores. This information is then used to generate trading signals and make informed investment decisions. By integrating sentiment analysis with other AI tools, traders can make more informed decisions and improve their overall trading performance. However, it is essential to recognize the limitations of sentiment analysis, particularly the potential for biased or misleading information, and the challenges of accurately interpreting nuanced language. Sarcasm, irony, and cultural context can be difficult for AI algorithms to detect, leading to inaccurate sentiment scores. Moreover, the proliferation of fake news and coordinated disinformation campaigns can further distort sentiment analysis results. A critical approach, combining sentiment analysis with other forms of fundamental analysis, is crucial for making informed investment decisions. 4.5. Portfolio optimization using AI-driven strategies. AI plays a significant role in portfolio optimization, enabling robo-advisors and hedge funds to construct portfolios that balance risk and return more effectively. AI balances risk and return in portfolio construction by 1. Analyzing historical data. AI models analyze historical data to identify patterns and relationships between assets, assessing correlations and volatility. AI algorithms can identify optimal asset allocations based on historical performance and risk metrics. 2. Forecasting future performance. AI models forecast the future performance of assets based on a variety of factors, including macroeconomic data, industry trends, and company-specific information. AI models incorporate a wide range of factors, including earnings forecasts, economic indicators, and market sentiment, to predict future asset performance. 3. Optimizing asset allocations. AI algorithms use optimization techniques to determine the optimal asset allocation that maximizes returns while minimizing risk. Optimization techniques include Markowitz portfolio optimization, Black-Litterman model, and robust optimization. Examples of AI-driven portfolio optimization. Robo-advisors. Robo-advisors use AI algorithms to construct and manage portfolios for retail investors. These platforms offer low-cost, personalized investment advice, and automatically rebalance portfolios to maintain the desired risk profile. Examples include Betterment and Wealthfront, which use AI to construct and manage portfolios based on individual investor goals and risk tolerance. Hedge funds. Hedge funds use AI algorithms to manage complex portfolios and generate alpha, excess returns. These funds employ sophisticated trading strategies, such as long-short equity, quantitative arbitrage, and global macro. Renaissance Technologies and Two Sigma are examples of hedge funds that use AI extensively in portfolio management. By leveraging AI, investors can construct portfolios that are tailored to their individual needs and risk tolerance, improving their chances of achieving their financial goals. However, it's crucial to remember that even the most sophisticated AI-driven portfolio optimization strategies are not immune to market volatility and unforeseen events. One major challenge is the difficulty of accurately predicting future asset returns, as historical data may not be a reliable indicator of future performance. Additionally, AI models can be overfit to historical data, leading to poor performance in new market conditions. Regular monitoring and adjustments are essential to maintain the desired risk profile and achieve long-term investment success. As we transition from these applications, it's crucial to examine the broader advantages AI brings to the market. 5. Advantages of AI in stock market forecasting. The integration of artificial intelligence, AI, into stock market forecasting has brought about a paradigm shift, offering several distinct advantages over traditional methods. These advantages stem from AI's ability to process vast amounts of data, identify complex patterns, and make decisions without emotional bias. This section will explore key benefits: speed and efficiency in market analysis, enhanced accuracy in predicting stock trends, elimination of emotional bias in trading, and the ability to handle large volumes of data in real time. 5.1. Speed and efficiency in market analysis. AI-driven systems can analyze vast amounts of data far more quickly and efficiently than human analysts. This speed advantage allows AI to identify trading opportunities and make decisions in real time, providing a significant edge in today's fast-paced markets. AI-driven funds have demonstrated their ability to outperform traditional methods. For example, quant funds, which rely heavily on AI and machine learning, have shown superior performance compared to discretionary hedge funds in recent years. A study by Barclay Hedge found that quant funds outperformed discretionary hedge funds by an average of 2% per year over the past decade. Compared to discretionary hedge funds, AI-powered quant funds offer several advantages. Automation. AI algorithms can automate many of the tasks that are traditionally performed by human analysts, such as data collection, analysis, and trading. This frees up human analysts to focus on higher-level tasks, such as strategy development and risk management. Scalability. AI systems can easily scale to handle increasing volumes of data, allowing them to identify more trading opportunities and manage larger portfolios. Objectivity. AI algorithms make decisions based on data, eliminating the emotional biases that can cloud human judgment. These advantages allow AI-driven funds to generate superior returns while managing risk more effectively. To put this into perspective, AI systems can process over 1 terabyte of financial data per day, analyzing millions of data points from various sources, including market data, news feeds, and social media. This is orders of magnitude faster than what a human analyst could achieve. 5.2. Enhanced accuracy in predicting stock trends. AI algorithms can identify complex patterns and relationships in financial data that are often missed by human analysts. This ability allows AI to make more accurate predictions of stock trends, leading to improved investment performance. Research supports AI's predictive superiority over human analysts. A study published in the Journal of Portfolio Management found that AI models outperformed human analysts in forecasting stock returns by an average of 10% per year. Backtesting results from AI models also demonstrate their predictive power. A backtest is a simulation of how an AI model would have performed in the past. These backtests often show that AI models can generate significant profits while managing risk effectively. Example of AI model performance. These results show that AI models can generate higher returns and lower risk than traditional investment strategies. 5.3. Eliminating emotional bias in trading. AI algorithms make decisions based on data, eliminating the emotional biases that can cloud human judgment. This objectivity leads to more rational and consistent trading decisions, improving overall performance. AI can prevent panic-driven sell-offs by objectively assessing risk. AI algorithms can objectively assess risk based on data, without being influenced by fear or greed. Maintaining a disciplined approach. AI systems can maintain a disciplined approach to trading, even during periods of market turmoil. Avoiding impulsive decisions. AI algorithms can avoid impulsive decisions that are often driven by emotions. Real-world examples demonstrate the benefits of AI in preventing panic-driven sell-offs. During the 2008 financial crisis, AI-driven funds were able to avoid the worst of the market downturn by sticking to their data-driven strategies. While many human traders panicked and sold off their assets at the bottom of the market. Human traders are often susceptible to cognitive biases, such as the herd mentality, where they follow the crowd and make irrational decisions based on fear or greed. AI algorithms, on the other hand, are programmed to make decisions based on predefined rules and risk parameters, regardless of market sentiment. For example, an AI algorithm might continue to hold a stock during a market downturn if its fundamental analysis still supports the investment thesis, while a human trader might be tempted to sell the stock out of fear. 5.4. Handling large volumes of data in real time. AI can efficiently process vast amounts of global financial data in real time, allowing it to identify trading opportunities and manage risk more effectively. AI is used in processing alternative data sources, such as satellite imagery. AI can analyze satellite imagery to track economic activity, such as construction, traffic, and retail foot traffic. Credit card transactions. AI can analyze credit card transaction data to track consumer spending patterns. Social media data. AI can analyze social media data to gauge public sentiment towards companies and industries. By processing these alternative data sources, AI can gain insights that are not available from traditional financial data sources. This allows AI to make more informed trading decisions and generate superior returns. However, it's important to transition to the flip side of the coin. While AI offers many advantages, it also has limitations and challenges. 6. Limitations and challenges of AI in stock trading. While artificial intelligence, AI, offers significant advantages in stock trading, it is crucial to acknowledge its limitations and challenges. These limitations stem from data quality issues, market unpredictability, ethical concerns, regulatory complexities, and the inherent nature of AI model development. This section will delve into these key challenges: data quality and overfitting issues, market unpredictability and black swan events, ethical and regulatory concerns in AI-driven trading, dependency on historical data for future predictions, model complexity and interpretability, the black box problem, data security and privacy concerns, the role of human oversight, and the potential for market manipulation. 6.1. Data quality and overfitting issues. The success of AI models hinges on the quality and representativeness of the data they are trained on. However, financial data is often noisy, incomplete, and biased, leading to inaccurate predictions and poor performance. Data quality concerns. Financial data may contain errors, outliers, and missing values, which can distort the learning process and reduce the accuracy of AI models. Furthermore, data may be biased, reflecting historical patterns and market conditions that may not hold in the future. For example, if an AI model is trained on data primarily from bull markets, it may perform poorly during bear markets. Data may also be skewed due to survivorship bias, where only the data from successful companies is available, leading to an overly optimistic view of market dynamics. Overfitting issues. Overfitting occurs when an AI model learns the training data too well, capturing noise and irrelevant patterns that do not generalize to new data. This leads to poor performance on unseen data and reduces the model's ability to make accurate predictions in the real world. For instance, a model might identify a spurious correlation between a specific economic indicator and stock prices, which is purely coincidental and not predictive of future performance. Strategies to mitigate overfitting include cross-validation techniques. Cross-validation involves splitting the data into multiple subsets and training the model on different combinations of these subsets. This helps to assess the model's ability to generalize to new data and avoid overfitting. Common techniques include k-fold cross-validation and time series cross-validation, which is particularly useful for financial data due to its sequential nature. Regularization methods. Regularization methods add a penalty term to the model's loss function, discouraging it from learning complex patterns that may be specific to the training data. Common regularization methods include L1 and L2 regularization. L1 regularization can also be used for feature selection, identifying the most important variables and discarding irrelevant ones. Careful data preprocessing, feature engineering, and model selection are crucial for mitigating data quality and overfitting issues. Data cleaning techniques, such as outlier removal and imputation of missing values, are essential for improving data quality. Feature engineering involves creating new variables that capture relevant information and reduce noise. 6.2. Market unpredictability and black swan events. Financial markets are inherently unpredictable, and even the most sophisticated AI models cannot perfectly predict future price movements. Black swan events, which are rare and unforeseen events with a significant impact, can disrupt market patterns and render AI models ineffective. Examples of black swan events include the 2008 financial crisis, the COVID-19 pandemic, and unexpected geopolitical events. These events often defy historical patterns and can cause significant losses for AI-driven trading systems. Approaches to improve AI's adaptability to unforeseen market conditions include stress testing. Stress testing involves subjecting AI models to extreme scenarios and assessing their ability to withstand market shocks. This helps to identify potential vulnerabilities and improve the model's robustness. Stress tests can simulate various market conditions, such as sudden interest rate hikes, currency devaluations, and geopolitical crises. Scenario analysis. Scenario analysis involves simulating different market scenarios and evaluating the model's performance under each scenario. This helps to understand how the model responds to different market conditions and identify potential risks. Scenario analysis can involve creating different economic forecasts and assessing the impact on portfolio performance. AI models should be designed to adapt to changing market dynamics and incorporate new information as it becomes available. Techniques such as ensemble learning, where multiple models are combined, can improve robustness and reduce the risk of relying on a single model. Furthermore, incorporating real-time data and adaptive learning algorithms can help AI models adjust to changing market conditions more quickly. 6.3. Ethical and regulatory concerns in AI-driven trading. The use of AI in stock trading raises several ethical and regulatory concerns. including market fairness, transparency, and accountability. Ongoing debates and regulatory frameworks include market fairness. AI-driven trading algorithms can potentially exploit market inefficiencies and create an uneven playing field for individual investors. For example, high-frequency trading, HFT, algorithms can front-run other investors, profiting from their orders before they are executed. This raises concerns about fairness and equal access to information. Regulators are exploring ways to ensure that AI-driven trading algorithms do not unfairly disadvantage individual investors. Transparency. AI models can be complex and opaque, making it difficult to understand how they make trading decisions. This lack of transparency can raise concerns about accountability and fairness. The black box nature of some AI models makes it difficult to audit their decisions and ensure that they are not biased or discriminatory. Accountability. When AI models make errors or cause losses, it can be difficult to assign responsibility. This raises questions about who is accountable for the actions of AI-driven trading systems. Is it the developers of the AI model, the traders who deploy it, or the firm that owns it? Establishing clear lines of accountability is crucial for ensuring responsible AI deployment. Regulatory bodies, such as the Securities and Exchange Commission, SEC, are actively developing frameworks to address these ethical and regulatory concerns. Algorithmic bias, where AI models perpetuate or amplify existing societal biases, is another significant concern. It is crucial for AI developers and traders to adhere to these regulations and promote responsible and ethical AI practices. The potential for job displacement in the financial industry due to AI automation is also a growing ethical concern. 6.4. Dependency on historical data for future predictions. AI models are trained on historical data, which may not accurately reflect future market conditions. This dependency on historical data can limit the model's ability to adapt to changing market dynamics and make accurate predictions. Approaches to improve AI's adaptability include adaptive learning. Adaptive learning involves continuously updating the AI model as new data becomes available. This allows the model to adapt to changing market conditions and improve its predictive accuracy over time. Techniques such as online learning and reinforcement learning can be used to continuously update AI models based on new data. Transfer learning. Transfer learning involves using knowledge gained from one task to improve performance on another task. In financial modeling, transfer learning can be used to leverage data from related markets or time periods to improve the accuracy of predictions in a specific market. For example, knowledge gained from analyzing the performance of tech stocks during the dot-com bubble could be used to improve predictions for tech stocks today. By incorporating adaptive learning and transfer learning techniques, AI models can overcome their dependency on historical data and make more robust predictions in dynamic market environments. However, it is important to recognize that even with these techniques, AI models are still limited by the data they are trained on. Human judgment and domain expertise are essential for interpreting AI predictions and making informed investment decisions. 6.5. Model complexity and interpretability. Developing and maintaining complex AI models requires specialized expertise and significant resources. Furthermore, the complexity of these models can make it difficult to interpret their outputs and understand how they arrive at their predictions. Need for specialized expertise. Developing and deploying AI models requires expertise in machine learning, statistics, programming, and finance. This can be a significant barrier to entry for smaller firms and individual investors. Risk of model drift. AI models can degrade over time as market conditions change. This phenomenon, known as model drift, requires constant monitoring and recalibration to maintain model performance. Difficulty of interpreting model outputs. Complex AI models, such as deep neural networks, can be difficult to interpret, making it challenging to understand how they arrive at their predictions. This lack of transparency can make it difficult to identify and correct errors. 6.6. The black box problem. The black box problem refers to the difficulty of understanding how AI models arrive at their predictions. This lack of transparency can make it difficult to identify and correct errors, and it can also raise concerns about fairness and accountability. Lack of transparency. The inner workings of complex AI models are often opaque, making it difficult to understand the factors that influence their predictions. Difficulty of auditing decisions. The lack of transparency makes it difficult to audit AI decisions and ensure that they are not biased or discriminatory. Concerns about fairness and accountability. The black box problem raises concerns about fairness and accountability, as it is difficult to hold AI models responsible for their actions. 6.7. Data security and privacy. Data security and privacy are critical concerns in AI-driven trading, as financial data is often sensitive and confidential. Risk of data breaches. AI models require access to vast amounts of data, which increases the risk of data breaches and cyberattacks. Importance of data privacy. Financial data often contains sensitive information about individuals and companies, which must be protected from unauthorized access. Need for robust security measures. Robust security measures, such as encryption, access controls, and data anonymization, are essential for protecting data security and privacy. 6.8. The role of human oversight. Human oversight is essential in AI-driven trading, as AI models are not infallible and can make mistakes. AI is not a substitute for human judgment. AI models should be viewed as tools to augment human judgment, not replace it. Human expertise is needed for interpretation. Human expertise is needed to interpret AI predictions and make informed investment decisions. Monitoring and intervention are crucial. Human oversight is needed to monitor AI performance and intervene when necessary to prevent errors or losses. 6.9. Potential for market manipulation. AI can potentially be used for market manipulation, such as creating fake news or engaging in spoofing. Creation of fake news. AI can be used to generate fake news articles or social media posts to influence market sentiment. Spoofing. AI can be used to engage in spoofing, which involves placing orders with the intention of canceling them before they are executed, to manipulate market prices. Need for vigilance. Vigilance is needed to detect and prevent AI-driven market manipulation. 6.10. The need for regulation. Regulation is needed to address the ethical and regulatory concerns associated with AI-driven trading. Ensuring market fairness. Regulation is needed to ensure that AI-driven trading algorithms do not unfairly disadvantage individual investors. Promoting transparency and accountability. Regulation is needed to promote transparency and accountability in AI-driven trading. Protecting data security and privacy. Regulation is needed to protect data security and privacy in AI-driven trading. Having discussed the challenges and limitations, it's useful to shift to practical, real-world cases. 6.11. Conclusion. In conclusion, Section 6 has highlighted the key limitations and challenges of AI in stock trading, including data quality and overfitting issues, market unpredictability and black swan events, ethical and regulatory concerns in AI-driven trading, dependency on historical data for future predictions, model complexity and interpretability, the black box problem, data security and privacy concerns, the role of human oversight, and the potential for market manipulation. Addressing these challenges is crucial for the responsible and effective deployment of AI in financial markets. by mitigating data quality issues, incorporating adaptive learning techniques, adhering to ethical and regulatory guidelines, and maintaining human oversight. AI developers and traders can harness the full potential of AI while minimizing its risks. The next section will explore case studies and real-world examples to illustrate how these challenges can be addressed in practice. It is crucial to critically assess these limitations to contextualize AI's role within stock market prediction. A balanced approach, acknowledging both the potential and the pitfalls, is essential for responsible innovation in this rapidly evolving field. 7. Case studies and real-world examples. To provide a more concrete understanding of AI's impact on stock market predictions, this section examines specific case studies and real-world examples. These examples showcase the successes, failures, and lessons learned from AI-driven trading systems, offering valuable insights for both institutional and retail investors. This section will explore AI-driven hedge funds and their performance, success stories of AI-powered trading platforms, and notable failures of AI-based trading systems. 7.1. AI-driven hedge funds and their performance. Several hedge funds have successfully integrated AI into their investment strategies, achieving impressive returns and outperforming traditional methods. These funds leverage AI to analyze vast amounts of data, identify complex patterns, and make informed trading decisions. Renaissance Technologies, founded by James Simons. Renaissance Technologies is one of the most successful AI-driven hedge funds in the world. Its Medallion Fund, which is only available to employees, has consistently generated exceptional returns, reportedly averaging over 30% annually, before fees, for over 2 decades. Renaissance Technologies employs mathematicians, physicists, statisticians, and computer scientists to develop sophisticated AI models that identify non-random patterns in market behavior. One of the key strategies employed by Renaissance Technologies is statistical arbitrage, which involves identifying and exploiting short-term price discrepancies between related assets. The firm's success is attributed to its ability to collect and analyze vast amounts of data, develop sophisticated AI models, and maintain a culture of innovation. However, Renaissance Technologies faces increasing competition from other AI-driven hedge funds, which are also employing sophisticated techniques and attracting top talent. This increasing competition may erode the firm's competitive edge and reduce its ability to generate superior returns in the future. Moreover, the Medallion Fund's capacity is limited, and it is not open to outside investors, which restricts its impact on the broader market. 2 Sigma is another prominent AI-driven hedge fund that employs a quantitative approach to investment management. The firm uses machine learning, natural language processing, and other AI techniques to analyze financial data, news articles, and social media posts. 2 Sigma's investment strategies include long-short equity, global macro, and quantitative arbitrage. 2 Sigma has developed a proprietary AI platform that automates many of the tasks traditionally performed by human analysts, such as data collection, analysis, and trading. The firm's success is attributed to its ability to attract top talent, invest in cutting-edge technology, and maintain a disciplined approach to risk management. 2 Sigma's success also depends on its ability to adapt to changing market conditions and avoid overfitting its AI models to historical data. The firm faces the challenge of maintaining the freshness and relevance of its data, as well as ensuring that its AI models are robust and generalizable to new market environments. These examples demonstrate the potential of AI to generate superior returns in the hedge fund industry. However, it is important to note that not all AI-driven hedge funds are successful. The success of these funds depends on several factors, including the quality of their data, the sophistication of their AI models, and their ability to adapt to changing market conditions. The increasing complexity of AI models and the need for specialized expertise also pose challenges for AI-driven hedge funds. These firms must invest heavily in training and development to ensure that their employees have the skills and knowledge needed to effectively deploy and manage AI-driven trading systems. 7.2. Success stories of AI-powered trading platforms. AI-powered trading platforms are revolutionizing both retail and institutional trading, providing access to sophisticated trading tools and strategies that were previously only available to a select few. These platforms use AI to automate trading decisions, personalize investment advice, and provide real-time market insights. Carve-Out. Carve-Out is an AI-powered investment platform that provides personalized investment advice and automated trading strategies to retail investors. The platform uses machine learning to analyze financial data, news articles, and social media posts, generating recommendations and managing risk. Carve-Out's AI-driven strategies have reportedly outperformed benchmark indexes, demonstrating the potential of AI to democratize access to sophisticated investment tools. The platform also provides educational resources and tools to help retail investors understand AI-driven trading strategies. However, Carve-Out faces the challenge of ensuring that its AI models are fair and unbiased and that its recommendations are appropriate for all investors. The potential for algorithmic bias is a significant concern for AI-powered trading platforms, as these biases can perpetuate or amplify existing societal inequalities. Furthermore, Carve-Out must provide adequate disclosures about the risks of using its platform and ensure that investors understand the limitations of AI-driven trading strategies. Sentient Technologies. Sentient Technologies, now a part of Cognizant, developed AI-powered trading systems for institutional investors. The firm used evolutionary algorithms and deep learning to optimize trading strategies in real time. Sentient's AI platform could analyze vast amounts of data and identify complex patterns that human traders would miss. While Sentient no longer operates independently, its technology has been integrated into Cognizant's AI solutions for the financial industry. Sentient's experience highlights the challenges of commercializing AI-driven trading technologies and the importance of adapting to changing market conditions. The firm's acquisition by Cognizant reflects the growing trend of consolidation in the AI industry and the need for specialized expertise and resources to develop and deploy AI solutions effectively. These success stories demonstrate the potential of AI to transform the trading landscape, providing access to sophisticated tools and strategies for both retail and institutional investors. However, it is important to note that AI-powered trading platforms are not without their risks. The potential for errors and losses due to algorithmic glitches or unforeseen market events is a significant concern. Investors should carefully evaluate the risks and rewards of using these platforms before making any investment decisions, exercising caution and maintaining a degree of skepticism regarding AI-driven investment advice. 7.3. Notable failures of AI-based trading systems. While AI has achieved notable successes in stock trading, it is essential to acknowledge the failures and lessons learned. These failures highlight the limitations of AI and the importance of responsible deployment and human oversight. The 2010 flash crash. The 2010 flash crash was a dramatic event that saw the Dow Jones Industrial Average plummet nearly 1,000 points in a matter of minutes, only to recover just as quickly. While the exact cause of the flash crash is still debated, many experts believe that it was triggered by automated trading algorithms that amplified market volatility. The flash crash highlighted the potential risks of relying too heavily on AI-driven trading systems and the need for better regulation and oversight. The event led to increased scrutiny of high-frequency trading and the implementation of new rules to prevent similar events from happening in the future. The flash crash demonstrated the importance of robust risk management practices and the need for circuit breakers to prevent runaway trading. It also highlighted the potential for unintended consequences when complex AI systems interact in unpredictable ways. Knight Capital Group trading glitch. There have been several instances of AI-driven trading systems making errors that resulted in significant losses. These errors can be caused by a variety of factors, including data quality issues, overfitting, and programming bugs. One notable example is the Knight Capital Group trading glitch in 2012, which resulted in a $440 million loss in just 45 minutes. The incident was caused by a software error that led to the unintended execution of millions of orders. The Knight Capital incident highlighted the importance of rigorous testing and validation of AI-driven trading systems before they are deployed in the real world. The Knight Capital incident underscored the need for comprehensive testing procedures and robust error handling mechanisms in AI-driven trading systems. It also highlighted the importance of human oversight to detect and correct errors before they escalate into significant losses. These failures demonstrate that AI is not a silver bullet and has its limitations. They also underscore the importance of human oversight and the need for a balanced approach to AI deployment in financial markets. It is crucial for AI developers and traders to learn from these failures and implement safeguards to prevent similar incidents from happening in the future. To provide a more engaging experience, visual aids that illustrate the performance of AI-driven hedge funds and trading platforms could be added here. For instance, graphs showing the returns of Renaissance Technologies Medallion Fund compared to benchmark indices, or timelines illustrating the key events leading up to the 2010 flash crash, would enhance the section's impact. With the insights from the case studies, we can transit toward the future. 7.4. Conclusion. In conclusion, Section 7 has provided a balanced overview of case studies and real-world examples of AI in stock trading, showcasing both the successes and failures of AI-driven systems. These examples highlight the potential of AI to generate superior returns, transform the trading landscape, and democratize access to sophisticated investment tools. However, they also underscore the importance of responsible deployment, human oversight, and continuous learning. The limitations and challenges highlighted in these case studies underscore the need for a balanced and critical approach to AI in finance, acknowledging both its potential benefits and its inherent risks. By understanding the lessons learned from these case studies, investors and traders can make more informed decisions about how to leverage AI in their investment strategies and avoid the pitfalls that can lead to losses. These findings pave the way for understanding the landscape of future innovations for AI in the stock market. They also emphasize that AI systems should be seen as tools to augment human expertise, rather than replace it entirely. 8. The future of AI in stock market predictions. As artificial intelligence, AI, continues to evolve at an unprecedented pace, its role in stock market predictions is poised for even more transformative changes. This section explores the emerging AI technologies set to redefine financial forecasting, the potential of quantum computing, AI's role in decentralized finance, DeFi, and the broader impact on retail investors and institutional trading. 8.1. Emerging AI technologies in financial forecasting. Next-generation AI tools are poised to enhance predictive accuracy and efficiency in financial forecasting, addressing some of the limitations of current techniques. Federated learning. Federated learning enables AI models to be trained on decentralized data sources, without directly accessing or sharing sensitive financial information. This is particularly relevant for financial institutions that need to comply with strict data privacy regulations. Federated learning can allow multiple financial institutions to collaborate on building AI models without revealing their proprietary data, leading to more robust and generalizable models. Transformer-based models. Transformer-based models, such as BERT, bidirectional encoder representations from transformers, and GPT, generative pre-trained transformer, have achieved remarkable success in natural language processing, NLP. These models can be used to analyze vast amounts of textual data, such as news articles, social media posts, and financial reports, to extract sentiment and predict market movements. Transformer-based models can capture long-range dependencies in text and understand the nuances of language, leading to more accurate sentiment analysis and improved forecasting accuracy. Explainable AI, XAI. Explainable AI aims to make AI models more transparent and interpretable, allowing users to understand how they arrive at their predictions. This is particularly important in financial forecasting, where regulators and investors demand transparency and accountability. SHI techniques, such as SHAP, Shapley additive explanations, and LIME, local interpretable model agnostic explanations, can be used to identify the key factors that influence AI predictions and provide insights into the model's decision-making process. These emerging AI technologies have the potential to significantly improve the accuracy, efficiency, and transparency of financial forecasting. As these technologies continue to develop, they are likely to play an increasingly important role in shaping the future of stock market predictions. 8.2. The potential of quantum computing in trading algorithms. Quantum computing holds the promise of revolutionizing trading algorithms by enabling them to solve complex optimization problems that are intractable for classical computers. Quantum computers leverage the principles of quantum mechanics to perform computations in a fundamentally different way than classical computers, offering the potential for exponential speedups in certain types of calculations. Quantum-enhanced machine learning. Quantum computers can accelerate the training and execution of machine learning models, allowing them to analyze larger datasets and identify more complex patterns. Quantum machine learning algorithms, such as quantum support vector machines and quantum neural networks, have the potential to outperform classical machine learning algorithms in certain tasks. Portfolio optimization. Quantum computing can be used to solve complex portfolio optimization problems, such as finding the optimal asset allocation that maximizes returns while minimizing risk. Quantum algorithms, such as quantum annealing, can potentially find better solutions to portfolio optimization problems than classical optimization algorithms. Risk management. Quantum computing can be used to improve risk management by more accurately assessing the likelihood and impact of extreme market events. Quantum simulation techniques can be used to model complex financial systems and assess the potential impact of various risks. D-Wave and IBM are leading the way in developing quantum computing applications for finance. D-Wave's quantum annealing computers have been used to solve portfolio optimization problems, while IBM's quantum computers are being used to develop quantum machine learning algorithms for financial forecasting. While quantum computing is still in its early stages of development, it has the potential to significantly enhance AI's predictive capabilities and transform the landscape of stock market predictions. 8.3. The role of AI in decentralized finance, DeFi. Decentralized finance, DeFi, is an emerging ecosystem of financial applications built on blockchain technology. AI has the potential to play a significant role in automating investment strategies in DeFi, enhancing liquidity provision, and improving risk assessment in DeFi lending protocols. Automated investment strategies. AI can be used to develop automated investment strategies in DeFi, such as yield farming and liquidity mining. AI algorithms can analyze market data and optimize investment decisions to maximize returns while minimizing risk. For example, AI can be used to identify the most profitable yield farming opportunities and automatically allocate capital to those opportunities. Enhanced liquidity provision. AI can be used to enhance liquidity provision in DeFi by predicting supply and demand and adjusting liquidity pools accordingly. AI algorithms can analyze trading patterns and liquidity levels to optimize the allocation of capital to different liquidity pools. Improved risk assessment. AI can be used to improve risk assessment and DeFi lending protocols by analyzing borrower data and predicting the likelihood of default. AI algorithms can analyze borrower credit history, collateral value, and market conditions to assess the risk of lending to a particular borrower. AI has the potential to make DeFi more efficient, accessible, and user-friendly. As the DeFi ecosystem continues to grow, AI is likely to play an increasingly important role in shaping its development. 8.4. The impact of AI on retail investors and institutional trading. AI is democratizing access to sophisticated trading tools and strategies, empowering retail investors and transforming institutional trading. AI-powered investment platforms for retail traders. AI-powered investment platforms are making sophisticated trading tools and strategies accessible to retail traders. These platforms provide personalized investment advice, automated trading strategies, and real-time market insights. Examples of AI-powered investment platforms for retail traders include Carve-Out, Plum, and Wealthfront. These platforms use AI to analyze market data, generate recommendations, and manage risk, allowing retail investors to make more informed decisions and improve their investment performance. AI-driven automation in institutional trading. AI is automating many of the tasks traditionally performed by human traders in institutional trading. This includes tasks such as order execution, risk management, and portfolio optimization. AI-driven automation is improving efficiency, reducing costs, and enabling institutional traders to focus on higher-level tasks, such as strategy development and client relationship management. AI is leveling the playing field between retail investors and institutional traders, providing access to sophisticated tools and strategies that were previously only available to a select few. As AI technology continues to evolve, its impact on both retail and institutional trading is likely to become even more pronounced. Moving on from future directions, it's important to wrap up what we have discussed. And that brings us to the end of today's video. Thank you so much for watching. I truly appreciate you taking the time to join me. If you enjoyed this video and found it informative, please give it a thumbs up. And if you're new here, don't forget to subscribe to the channel and hit the notification bell so you don't miss any future uploads. Thanks again for your support, and I'll see you in the next video.